Welcome everybody back to day 5 of the 30-day Trader Induction program here on my channel. Today we're going to dive into some basic market analysis and just provide some different principles and concepts that you can apply in your own trading to increase your ability to analyze the market and interpret the data in an accurate way. But first up, we're going to discuss the two different types of market analysis. The first being the fundamental analysis, which involves the assessing of an asset's value based on the economic, financial, and qualitative factors to guide the trading decisions. Now, this is when it comes to maybe a stock, for example, this is going through their balance sheets, how well all their financial reports are going, looking up the upcoming financial announcements and economic events surrounding that stock and determining a position and a bias for your investment with regards to the asset that you're trading. This is one way of doing it, but not really the topic of discussion for this video nor this entire presentation. We are technical traders. Well, I am, and that is the information that I am putting forth here. And technical analysis involves evaluating an asset's price data through charts and indicators to forecast future market movements. So we're looking at the charts, we're dissecting all the information, we're interpreting the data, and then making judgments based on that information. Now, a couple of basics with regards to a price chart specifically. We have time and price. So time is on the x-axis and price is on the y-axis. And I've made a little chart here for you to visually exemplify that concept. So as price goes forward in time, where we're expanding to the right-hand side, going from left to the past to the right-hand side in the future. And then on the y-axis, you've got the higher the price and the lower the price. Now, moving on, we've got some different chart types. There's plenty of different chart types. You've got line graphs, candlestick charts, Heiken and Akashi. You got bar charts, the whole 9 yards. But myself, primarily, I only really use the candlestick charts and the line charts for all of my analysis. So they're the main ones that we're going to be discussing in this video. Now, a candlestick, or a Japanese candlestick for this matter, is a symbol that encodes price, some information about price within the candlestick itself. So first up here you have a bullish candle, and the 4 bits of information that are encoded within it is the open price, the low price, the high price, and the closing price. Now the sequence in which they occur will differ and vary based on whether it's a bullish or a bearish candle. For the bullish candles, it's the price will open on the candle, it will make a low, it will come up, make a high, and then fall back down to a close. And then with regards to a bearish candle, the markets will open the new candle, price will make a high, come down, make a low, and then close. So that's the sequence of the candlestick: the open, the high, the low, and the close, the OHLC. And on the top right hand corner, this example up here is a line chart where it's just a raw, accurate representation of where price is in time and price on that scale. Now, the next fundamental bit of analysis that we can use to assist in gauging where the markets may be heading next, or at least trading to or from, is levels of support and resistance. And what they are just price points in the market that cause a reversal in price. That's it. I'm not going to go in any more depth on what support and resistance is, why it works, how it works, etc. That could be a video for another time. But for now, price points in the market that cause a reversal in price. So this is a USD CAD on the weekly time frame down here. And what we can see on the upside, we have this zone at the top, which is indicative of a resistance or a ceiling, that every time that the market has rallied up into, the sellers have stepped in and pushed price back to the downside. So the bears have been taking control at this barrier. Now, on the flip side, you have this supportive region down the bottom, that every time price did move down into that region, the bulls stepped in and pushed price way back to the upside. So you can see here there's a wall in which the bulls and the bears are fighting on both sides, trying to gain control and push price continuously in the next direction. So the game of trading is all about identifying these areas in which the opposing force may step in and then taking a position based on that. So support and resistance is a very useful tool in allowing us to identify where the markets have turned around in the past, which can give us an idea on what may happen the next time price does revisit these same price points yet again in the future. Now moving on to market structure. Market structure is a principle to understand the waves of the market moving in a series of higher highs, higher lows, lower highs, and lower lows. It's a principle to help you understand and visualize the movements in price that can so often be very sporadic and looking a bit crazy. So this is like a guideline and a barrier that allows us to really bring some order to the chaos, if you will. Now in this description here, we've got price starting on the left hand side, moving over to the right hand side. However, in this case, in a series of higher highs and higher lows, higher high, higher low, before ultimately stalling out at the top and price starting to reverse. So once we did get this trend change to the downside as price broke through this last higher low, this is the indication that the market has gone from a bullish sentiment down into a bearish sentiment, and we're able to utilize these swing points in the market through this principle of market structure to identify where the market currently is within its trend, and also where it may be heading next based on what's happening in the markets from a contextual point of view. Now, in summary, this one is just going to be a nice, short, sweet video. We're going to go deeper into the technical analysis over the coming days next week, and where I'll really break down the support and the resistance, ways in which we can calculate the market structure and measure it, and identify it in different ways, as well as utilizing more and more tools within the TradingView software to help us really refine our edge in the markets. But just for now, was just a basic and a brief overview of the different types of market analysis and ways in which one can understand the market data. So we covered the types of the market analysis, which was the fundamental and the technical. I'm a lot more knowledgeable with regards to the technicals, and I don't put too much attention on the fundamentals outside of knowing when the upcoming high risk news announcements may be dropping. You got the price and time axis, so you got time on the x-axis and price on the y-axis, and then the markets trade relative to that scale. You've got the Japanese candlesticks, which is the individual candlesticks on the chart, each of those representing a different unit of time. So if you're looking on a monthly time frame, you've got the open, high, the low, and the close of the month, but you've got that same symbol being utilized on, say, a 1 minute or a 2 minute time frame, and obviously the whole spectrum, which again represents of that minute or 2 minute or the frequency of time. You've got the open, the high, the low, and the close relative to which frequency or which time frame we're looking at. Moving on, we have the support and resistance, which are just the turning points in the market. We're looking for the bulls to push up into the resistance, and then the bears to push down into the support floors. And at those levels where the market has previously turned away from is where that battle is taking place, so to speak. Moving on to the market structure, this is just the principle of the higher highs and the higher lows, the swing points in the market, and giving a bit of structure and order to the chaos that is the markets chopping around, so it can assist with bringing clarity and order to the interpretation of it. Now, next up on day 6, we're going to be going over my favorite episode personally, which will be some basics of risk management and different strategies and concepts that we can implement into our trading to make sure that we're not only executing efficiently but managing our downside risk, because that's always a potential. But without further ado, thank you very much for your time, and I'll see you in the next one.